Right then, folks, good morning from us, and just another update at the end of a pretty chaotic week of trading. We'll try and break it down. We'll try and make sense of it. There's a lot of things to go through, a lot of different issues that we've had over the course of this week, and we will get back to that in a second. But obviously, we'll start with the calendar. All right, we'll start with the calendar. Have a quick look through the calendar. We had CPI out of the US on Tuesday, with the ECB out on Thursday, and normally they would be the main focuses of attention on a week like this, but they were anything but. Right, if you go back to last week and you look at the reports out of America, that the banking sector in America was struggling. You see the Silicon Valley Bank and the Signature Bank had a series of failures, and a liquidity crunch in the banks. They couldn't pay out the depositors, and just had general failures in the bank, which showed pressure on the financial system after the ongoing interest rate hikes that we have had over the course of last year. Now, over the course of Sunday, right, the Fed did come out and announce announced what they call their bank term funding program, and also banking authorities over the weekend together announced full protection to depositors at these failed banks. So they've come out and they've introduced liquidity measures to provide support to these banks in order to pay out depositors, right? So banking, the couple of banks collapsed, a couple of banks were in trouble, and the Fed then stepped in, and the banking authorities have stepped in order to guarantee depositors their funds. So crisis slightly averted with that one, but that did not change the picture heading into Monday. Pretty choppy week, across the board on stocks. Pretty choppy week across the board in stocks. But you can see this move lower on Monday on the S&P, quite a substantial move lower. You can see the move lower at the open on the DAX. If you delve into these other stock indexes, you can see the same thing. Bit of downside in the FTSE across Monday morning, and just general stock index weakness to kick off the week. Pretty sour risk sentiment, and yeah, was not positive, certainly to begin the week in terms of stocks. Right, messing up my words, but that then brings us into Tuesday. Right, it brings us into Tuesday with the CPI prints out of the US. Slight positivity around the unemployment rate with sterling, but it's largely taken a back seat over the course of this week. We can see the core CPI print, right, previous 5.6%. Consensus was for 5.5, a slight decrease, and that's exactly what we got. Right, same thing with the total rate of inflation. You got previous 6.4, consensus 6%, actual 6% as well. Right, so pretty in line with expectations, or bang in line with expectations, which means the Fed need to keep the foot on the gas in terms of their battle against inflation. But we will come back to that later on in the video as we allude to the Fed next week. Right. Bring you back to Wednesday then. Have a look at Wednesday. Not a great deal out over the course of Wednesday in terms of the calendar, with some PPI figures out of the US, some retail sales figures out of the US, both slightly negative, but really that was overshadowed by the situation with Credit Suisse. Now, obviously, these interest rate hikes are proving troublesome across the world. It was previously confined to America, but the problems in Credit Suisse are slightly different and slightly longer lasting. I mean, you just stick this chart back to as long as you want to go. It's down 97% from the highs when you go back to the all-time highs back set 10-15 years ago. So problems with Credit Suisse, they released a report kind of during the week that there were material weaknesses within their reporting, and then their largest shareholder decided to come out and say that they will no longer be offering liquidity or no longer be offering support to the bank, which obviously it needs, right? So the Saudi National Bank, the highest shareholder, removing support for the bank with these higher levels of interest rates means that this stock got hammered at the open on Wednesday. You can see from the close on Tuesday down to the low on Wednesday, a further 30% drop. How much lower can the thing really go? It's obviously in a fair bit of trouble, long term in a fair bit of trouble with numerous scandals throughout the bank. And yeah, generally, with liquidity measures and with support from the bank being removed from its largest shareholder, means it's pretty difficult to see any positivity around that bank. But the SNB, the Swiss National Bank, came out and said that they were going to provide $54 billion or close to $54 billion worth of liquidity or worth of support to the bank in order for it to keep functioning. So central banks have stepped in and saved the day. The Fed stepped in and saved a couple of American banks. The SNB have stepped in and saved Credit Suisse. And you've seen downside, you've seen negativity off the banks being in trouble, and then you've also then seen positivity around the banks being saved as such. So pretty difficult week of, certainly in terms of stock indexes. You can see across the 4-hour time frame, certainly across the US indices, very, very choppy over the course of the last few days. Over the course of this week, see the S&P really, really choppy. You can see the Dow really choppy, but the Nasdaq itself has been pushing higher. And Russell pretty choppy, but investors seem to have moved towards tech stocks. They seem to be favoring tech and growth stocks in order to generate some returns for themselves going forward, possibly off the back of expectations for the Fed to slow down the pace of rate hikes, or even stop soon the pace of rate hikes. So we'll have to see then next week when it comes around to that, but bit more clear direction across the DAX, across the FTSE, pretty clear downside across the board when it comes to across the lower section of this board with your Nikkei, with your FTSE and with your DAX. Yesterday we did have some comments out from Jeremy Hunt that the UK are likely to avoid a recession. A number of tax measures introduced to help, but inflation should be halved by year end, which would be nice. But if the UK are going to avoid a recession, that is then positive for the currency. If we just flick onto cable, you can see some solid upside across the board. It is across the board on sterling, but you can see some pretty solid upside across sterling over the course of this week, certainly from Wednesday up until now, with those announcements that the UK is likely to avoid a recession. UK, or the sterling has liked that and enjoyed that over the past couple of days, so maybe something to keep an eye on going forward. It's certainly pulled back into a decent level now to keep an eye on, certainly. But some pretty big downside last week across these assets, but have slightly bounced back, and we have seen some ongoing dollar weakness over the course of the start of this week. Then an extremely strong bounce back in the dollar, as you can see, off the back of the Credit Suisse reports that we were looking at, and euro dollar itself got absolutely smoked off the back of it. It was down 200 pips, but now it is kind of grinded higher and sort of met back in the middle, and it's now pretty flat, pretty unchanged on the week, which is a pretty wild week of trading across euro dollar for not much gain. So a bit of negativity across markets, which you can see then across the board. Bond yields, US yields, the biggest downside, biggest 3-day downside since the 1980s. Massive downside in yields off the back of a safe haven play, and they've not really bounced back. So maybe that's something we need to keep an eye on going forward, that yields have not bounced back or held firm as well as some other assets. See massive downside across bond yields on Thursday and Friday of last week. Had a little bit of a bounce, and into Monday, this week, a little bit of a bounce back on Tuesday, and then the Credit Suisse report hits, and again massive downside then on Wednesday morning, and they have not bounced back the same way some other assets have themselves. The S&P has broken out and through these highs, so a bit of positivity surrounding that, but oil remains under pressure. Gold, a bit of safe haven flows, has risen over the course of this week. Pretty strong upside across the price of gold, and you can see Aussie yen and CAD yen both down pretty substantially over the course of this week. You come across the commodity space, you can see copper downside, clear oil downside, some natural gas downside, but I think what is interesting, or one thing that I find interesting, is Bitcoin remains resilient, right? It has accelerated higher over the back end of yesterday and over the start of today as well, up through the highs here at 26,500, as you can see. Maybe have some potential bets that the banking system will collapse. Certainly these crypto fanatics will have been hoping for that, or something similar to that, but people taking a punt on some Bitcoin off the back of some potential for that happening. Maybe not the worst thing in the world. So Bitcoin enjoying it, risk assets across the board not enjoying it, and that is where we are really at over the course of this week, right? And brings us into ECB as to yesterday, who didn't shy away from the 50 basis point hike. They did hike by 50 basis points, and 4 of the members in of the ECB decided that thought that there should be no interest rate hikes, and they should hang on a little bit to wait and see how things play out. But that's not really how that has played out, right? They have hiked interest rates by 50 basis points, but they did hike kind of dovishly. They did say they were prepared to help out if needs be. and removed forward guidance for ongoing interest rate hikes. So I think they're going to go, maybe not on a pause, but they're going to wait and they're going to see how things pan out with the financial system over the next weeks before they make any decisions as to whether they're going to hike rates again. Right, we were expecting a 50 basis point hike at the next meeting, as they had told us. They had given us forward guidance to expect that. Now it's not so same. Now it's not the same. As they have removed that from their comments. Brings us into Friday today. Nothing really out on Friday, but a pretty wild week across the board this week. Assets flying higher, flying lower, regardless of where you look. Pretty difficult sometimes to keep on track of it all. But that then brings us on to next week, and you can see the Fed then next week, expecting a 25 basis point hike out of the Fed next week, which I think we will get. But then a kind of a catch-22 scenario. Do they continue to hike interest rates to cool down inflation and risk causing further pressure on the financial system, or do they stop hiking interest rates, show they are afraid, and then still cause potential chaos that they are afraid? But stocks will probably like that if they stop hiking interest rates. But should they? That shows that they are afraid, and if they're afraid of the financial system or the banking system, it's not really a situation where stocks would move higher. But that's the wonderful world of financial markets. Some things just don't, sometimes markets just don't move with logic. The logic would suggest that maybe it's not a good thing, but I don't think buying stocks after they push lower is ever too bad an idea, regardless of the situation. So we'll have to see then how they come out with their economic projections as well. But their interest rate decision, they're likely to hike by 25 basis points, I think, and then communicate to us that they need to see how things pan out going forward. I think at the Bank of England on Thursday, another 25 basis point hike, and we're expecting them to stop hiking interest rates after that, and then go on pause and then see what the current rate of hikes decide to do, or see how the current rate of hikes, current interest rate fares in cooling down the economy. They're expecting to avoid a recession. Certainly Jeremy Hunt's expecting to avoid a recession, and also half the levels of inflation. So if they think that their current interest rate can do that, they will probably have a reluctance to continue to hike. But we'll obviously have to see next week when that comes around to it. But pretty chaotic week. Lots of movement wherever you look. Things up, things down. Risk sentiment under pressure over the course of the week, and that is how it's looking into the weekend. As markets have stabilised over the back end of this week, certainly into today, not a massive amount of price movement. So do we get a bit of chop until the end of play today? I don't think that would be too far-fetched to suggest that, but we'll have to see how it plays out over the rest of the day. Over the weekend, do we get any more information on any banks being in trouble, any sort of move further towards a collapse of any of these banks? We'll have to see how that plays out over the course of the weekend. But we'll see on Monday. We'll get back to trading on Monday, and we will see how that pans out. But until then, probably keep your money in your pocket and see how it plays out into next week. If you didn't catch any of the moves this week, don't worry, there's always more opportunities, which we will try and dissect at some point next week. So that's it from me then, folks. Have a nice weekend, recharge the batteries, get some rest and relaxation in, and I will speak to you all again soon.